Yeah, thank you everyone for joining us, and thank you, Stefan and David, for accepting our invitation. Today we are speaking about measuring liquidity risk in the global financial system and interconnections that this has with the political economy angle of it. We are going with Stefan first for 15-20 minutes, then David will take it away, and then we will allow, as usual, for the speakers to interact with each other for about 10-15 minutes before opening up the floor to the rest of the audience. So, Stefan, whenever you're ready, please, the floor is yours.
Yes.
Perfect. Okay. All right. So I'm going to talk about sort of a very specific subset of the broader topic of this seminar series and this specific topic given for this specific event. I'm going to talk about bank failures. I'm going to try to think about liquidity versus solvency in bank failures. And I just want to start out by saying these are just all my private views. There's nothing official policy from the Federal Reserve here. This is just based on my own research. So just sort of set the stage, because this seminar series is about liquidity. Liquidity is a little bit of a catch-all term, if you want, and means a lot of different things to different people and has different meanings in different contexts. So let me just sort of start out with saying, to me, there's sort of two types of liquidity that we can think about. There's market liquidity, so we think about the ease at which we can trade an asset. And then there's funding liquidity. So the household or a corporation wants to raise some funds, then funding liquidity is going to be how easy it is for that household or corporation to raise funds. In this specific presentation, I'm going to talk about bank runs and liquidity in banking. And in some sense, that's going to be primarily concerned with funding liquidity. So any statement I'm going to make, whether that's normative or positive, it's just all going to be about very specific, the notion of liquidity and funding liquidity in the context of banking, which is sort of more concerned with the liability sides. Of course, there'll also be interactions with the asset side, but we'll maybe talk about that a little later. All right, so what I want you to take away from my remarks is that I'm going to give you sort of my worldview that comes out of my own research, which is that when you think about the issue of liquidity being a driver of important events in the banking sector, then I personally have convinced myself that bank runs and liquidity shortages as a cause of bank failure, or more broadly, banking crises, are overrated. What do I mean by that? Well, when we study historical evidence, it turns out that bank runs have historically been in existence. They happened. Bank runs happen all the time. But what they really did, they determined whether a bank failed or whether a banking crisis happened at a given point in time, but they weren't really the cause. So in some sense, the failure, the adverse event that we're thinking about would have happened even absent the bank run. And so the underlying bigger notion, why is that? How can that be? Is really that, well, the evidence sort of suggests, and then you can sort of think that through theoretically, is that banks can distinguish between liquidity and solvency-driven distress of other banks. And that sort of means that liquidity-driven events, purely liquidity-driven events, are often contained even absent in government intervention, absent any kind of government interventions. Okay, so turns out before the existence of deposit insurance and sort of broad-based central bank liquidity interventions, the private sector typically, the banking sector typically was able to sort out liquidity issues on its own. Okay, and so just want to be very clear, these insights are based on at least two papers. One is with Sergio Correa and Emil Verne on fading maps, not yet published, and then another one with Christian Blickler and Markus Brunnermeier that's published in the RFS. And then some other work that I'm doing together with Sergio and Emil at the moment. Okay, so let's sort of think about why is it that banks fail, or what causes banking crises? There's sort of different types of explanations that come out of both banking theory and historical accounts of banking crises. So what I mean by a liquidity-driven failure, well, a liquidity-driven failure starts with the observation that a bank is in the business of investing in illiquid long-dated securities and financing those with short-term debt. Now, it's theoretically then well understood that that sets the stage for multiple equilibria. And in a bad equilibrium and an adverse equilibrium, depositors coordinate collectively on withdrawing their funds from an otherwise healthy bank or banking system, and then force that bank or banking system to engage in some kind of behavior that reduces solvency, and by that sort of trigger a self-fulfilling panic-based failure of the institution, or a panic-based banking crisis. Now, another arguably equally extreme view is that failures are really insolvency-driven. So it starts with the observation that banks are in the business of exposing themselves to credit risk, potentially interest rate risk, and like any firm, they can be subject to governance issues, and all these kind of things such as fraud, interest rate risk, or credit risk can push the market value of a bank's assets below the market value of its liabilities, and by that just induce insolvency. And let me be very clear. The theory also allows us to sort of connect those views. I sort of hinted to that in that earlier slide on market and funding liquidity. So it's possible that you can construct arguments where there's first a shock to the value of the bank's assets, then depositors observe that shock, and then they start to worry about what other depositors observe, and then they start to, because of that, run on the bank. So in some sense, you can create an equilibrium where where a bank would have survived absent depositor withdrawals, but depositors would have never withdrawn to begin with if fundamentals hadn't been weak. Okay, so if you can combine those things, but really it's fundamentals that come first, and then they're amplified by coordination failures. And why am I saying all of this? Well, what I'm really interested in my research agenda, I want to understand which types of these failures are most empirically relevant. Or said differently, do bank runs present a common cause of bank failure? So is it the case that when a bank fails, the counterfactual is had depositors not withdrawn, it would have survived? And I just want to emphasize it's an extremely important question from policymakers, not just an academic point of view, just the policymakers' point of view, right? Because if you take the worldview that distress events in the financial sector and the banking sector are really liquidity driven, the types of policy interventions you're going to prioritize naturally are very different if you think they're primarily insolvency driven. So this question is extremely important. However, it's extremely hard to answer. Okay, you cannot answer it essentially empirically by just downloading some banking data of any banking system, basically from the last 80 years, for the very simple reason that governments are generally across all major jurisdictions in the business of providing kind of interventions that make those liquidity-driven events less likely. So said differently, if I told you, well, observe that in the current US banking system, there's hardly ever a failure with a bank run. So bank runs cannot be a cause of bank failures. Well, then you would just say, well, that's just because the government is providing deposit insurance and has, because of that, through that, driven these kind of events into extinction. So the broader research agenda that I have here is that, well, there's an opportunity for us to go back in history and study banking systems without deposit insurance, or even banking systems without deposit insurance, without central banks, or without committed lending of last resort policies. So very much unregulated banking systems where the data is much closer to the sort of theoretical models that we use to teach banking. So the few facts that I want to show you over the next slides are going to be based on these two papers I mentioned. In the first paper, we essentially created a panel of banks, of all major banks in the United States from the Civil War until today. So that is a huge data set, which part we have made publicly available already. We're going to make it all publicly available eventually upon publishing the paper. But that data set essentially contains information on 37,000 distinct banks, of which 5,000 banks fail at some point over the sample period. And the beauty of this data set, it's going to include a part of the sample before the Federal Reserve is in existence, before the FDIC is in existence, and then one where it is in existence. So that sort of allows us to understand commonalities in failing banks, compare them to non-failing banks. And the second paper I'll very briefly mention at the end is going to use microdata on commercial banks in Germany during the Great Depression and one of the biggest financial crises in history. And the beauty of that data is this is, again, a totally unregulated banking system. There's essentially no capital regulation. There's no deposit insurance. And then we have monthly data during a major financial crisis, and we can sort of trace the dynamics of deposits throughout that crisis. So let me briefly tell you a few things about failing banks. So what I'm plotting you here is the deposit growth of a failing bank between its last publicly available balance sheet before it fails and then the amount of deposit it has in failure. And I'm doing that for two samples. I'm doing that for a pre-FDIC failure, for which I have data from 1880 to 1934, and then a post-FDIC data set that's from 1993 to 2023, okay? So if you look at the orange distribution, you see that essentially in the modern US banking system, by modern I mean sort of the last 30 years, a bank before it fails loses on average maybe 2% of its deposit funding, and the tails are very thin. So there's very few banks that actually lose a lot of deposits before they fail. If you look at the green line, it shows the distribution is very much shifted to the left. The mean is something like 12%. So a failing bank on average would lose 12% of its deposit funding right before it failed. And the tails are really thick. So there's all these events where banks lose up to 30, 40% of their deposit funding. So what I'm trying to say is deposit outflows happened before bank failures in the historical banking system, but they don't happen anymore, okay? That doesn't yet tell us anything about whether the deposit outflows are causing failure. So I'll come to that in a moment. what it does certainly tell us they may be important in determining the timing of failure. To make that point, let's just look at the weekday of a bank failure in the historical US banking system and sort of juxtapose that against what's happening in the contemporary banking system. Well, it turns out, historically, banks essentially uniformly fail across the week. They're a little less likely to fail on a Saturday. They don't fail on a Sunday because they're closed. On a Saturday, they're a little less likely to fail. It's probably, because people are taking a bath or they're getting some groceries, whatnot. So they're a little more likely to fail on a Monday. But really, it sort of looks like a uniform distribution throughout the week. So it's pretty random when you fail because it's a decision by the depositors to close the bank. It's not at all the case in the contemporary US banking system, where banks almost always fail on Friday because it is a supervisory decision when a bank fails. It's not the decision of depositors. But again, there's nothing about the cause of bank failure right here. So we do in our work is we sort of try to understand whether there are commonalities across failing banks before they fail, and whether we can actually predict failure before it happens using historical variation. And just to sort of give you a few facts that indicate to you that there's extremely high predictability in bank failures, I'm just plotting here for the modern sample from 1959 onwards, what happens to various metrics of bank solvency right before they fail. When I say right before they fail, I mean the last 10 years in existence of a bank. So it's actually a pretty long period. What you see here is the blue line. Around 5 years before a bank fails, its non-performing assets start to go up. As a consequence, the bank has to provision for the losses. The provisions go up. Provisions are income effective, so the net income goes down, and the bank capitalizations fails as well, as these banks are seemingly unable to raise new equity. Okay, so you see these very clear pattern. A bank slowly has its capitalization erode before it fails. So the equity over assets ratio falls by something to close to 8 percentage points. Okay, so if you think the average bank has 16% of equity over assets financing, then that's actually a pretty substantial drop. Now, what's really interesting is you can do the same graph for the historical US banking system that includes the era before the Fed is in existence, sometime with the Fed in existence, but no FDIC. Turns out, again, you can get these very clear patterns of deteriorating solvency in failing banks many years before they fail. Now, we have some differences in the accounting and the kind of variables that are available to us, but you'll see in the historical US banking system, non-performing loans start to slowly increase in these failing banks. Their capitalization goes down, and the probability of a proxy for their income, the probability of dividend payouts being restricted, goes up. So in our work, we show that these kind of patterns allow you to very precisely predict which banks are going to fail. And they may not be so surprising for the modern US banking system, where the supervisors make the decision to close the bank, and supervisors may be slow, but it's the same. The same is true for the historical US banking system when depositors are making that decision. Okay. Now, predictability per se doesn't necessarily tell you anything about the cause of bank failure. So we need to do a little bit more. So just highlight one fact for you is that when banks failed historically in the United States before the FDIC was in place, the assets that they were still holding as they went through bankruptcy or receivership, the equivalent of bankruptcy for banks, the assets that they were holding were very much in distress. So when banks were closed, we understand the OCC that supervises the national banks documented exactly what happened in each failure of a national bank throughout receivership. When they closed the bank, they assessed immediately what's the value of the assets. In most cases, they found that around 18% of the assets are worthless, and around 47% were doubtful. Okay, what that meant is, in effect, as receivership progressed, these banks had actually recovery rates on all the nominal assets they were holding when they closed, only of 51 cents on the dollar. And depositors, as a consequence of that, realized very large losses. And I just want you to understand that there's very much limited scope for a bank run to reduce the value of assets that are still held by the bank once the bank run has concluded and the bank is closed, right? So the value of those assets are not affected by the fire sale of the bank run. They're only affected by the efficiency or inefficiency of the receivership. Now, what's interesting is historically receivership in the US, as it says, receiverships, the assets are just being held to maturity. So we can sort of very much see what's the market value of these assets. And that seemed to be very low. So the run primarily destroys the franchise value of the banks, which we cannot measure. But given that the assets that the bank was still holding are so low, in most cases, it turns out that even before the FDIC is in place, these bank failures, even when they featured runs, were runs on deeply insolvent banks. Okay, so I'm not going to give you all the details. There's more arguments in our papers, but there's sort of a lot of evidence that sort of suggests that these banks, mostly when they failed, were deeply insolvent. And you have a very hard time of coming up with a logic where the run is the original cause of failure. Now, let me tell you sort of, before I conclude, just very briefly from this other paper on the German crisis of 1931. So if you Google bank run and you look at the Wikipedia article of what describes bank run, you'll find this photo, which is individuals withdrawing from a savings bank in Berlin in July 1931. And that's just to say, the German crisis of 1931 is one of the most iconic financial crises out there. It's really a major meltdown of a financial system. And the beauty is, throughout this crisis, we have very detailed data on the balance sheets of around 120 banks that were in existence at the time in Germany. We have them at a monthly frequency with high granularity. And so what we can exploit is that out of the 120 banks back then that were in existence, 20 failed throughout the crisis. And one of the facts that we found, which I think are really striking, is as this bank run progresses, before the system entirely collapses, there's sort of this slow-moving bank run over the course of 3 months, where deposit funding of the entire banking system declines by something like 20%. If you look at the difference of deposit funding between failing and non-failing banks, that's this plot here, you see that really the total deposit funding, there isn't much of a difference between a failing bank and a non-failing bank. So everybody loses about the same amount of deposits. But banks that end up failing, they essentially lose all their interbank funding. Okay, and you can even show more. You could see that there's banks that still get deposit inflows during this major crisis, and they're going to re-intermediate these deposits, this deposit inflow, to banks that are losing deposits, but only banks that don't end up failing. Okay, so what that's trying to say is, well, it seems to be that interbank markets seem to be extremely resilient, but just banks protect themselves exactly against those institutions that are going to be insolvent because they have an understanding of who is facing a liquidity issue and who is not. And there's sort of more evidence that we're working on right now in follow-up work on the US banking system. There are several bank runs that we can document through newspapers and other sources where we will find that a bank run happens, people panic, but then a bank just borrows from another bank, or it's into the interbank market more generally. And by that, it's just able to fend off the crisis. But that's only ever the case if this institution is actually not insolvent. Okay, so this brings me back to my original point. So what I really want to push is this notion of liquidity, and I hope to stimulate some discussion going forward in this panel. The notion of liquidity in banking, I think, is very much overrated. And the focus of policy should be much more often on solvency rather than liquidity. And that's not just true ex ante in preparation for a crisis. It's also true ex interim. So once a crisis has happened, the fundamental problem that you're looking at is one of solvency. Then you need to recapitalize. You can't throw just liquidity at the issue. And sort of spinning it a little bit into the political economy direction, it's just really easy for policymakers to provide liquidity. It's very hard to deal with solvency issues. But still, I think we as academics need to sort of understand, and policymakers need to understand, that maybe if solvency is primarily the issue, we need to come up with solutions of how to, in case of crises, deal with those directly. So I'm going to leave it here and try to stop sharing.
Thank you.
Forward to David.
And we love provocative points, so I'm sure this will lead to a lot of discussion later on. And I have already several questions. I look forward to David now. David, the floor is yours. Take it away.
Thank you, Dario. And it's a great pleasure to be on this panel. And Stefan, I really enjoyed your talk and lots of food for thought in what you just said. So let me start by sharing my slides. Let's see if I can do that. So this is going to be a bit of a gear change. So hopefully this, combined, there's a lot of stuff we can kind of get into here. But I'm a former regulator, really. I used to work at the Bank of England in the financial stability group there. I worked a little bit on the reform of financial regulation after the financial crisis. So I'm going to give you a little bit of a take on how I think thinking about liquidity regulation has evolved. That's the theme. So I guess my first slide, Stefan already kind of covered some of these topics, which I predicted he would, which is very good. But I guess the point I want to make is I think we have a pretty good conceptual understanding, at least, of how liquidity can dry up not just in banks, but in financial markets more generally. So this is a kind of a famous, very famous picture from a Brinemeyer and Pedersen paper. It's quite an old paper, actually, that was written before the financial crisis. And it kind of shows you this interlinkage between problems with market liquidity and funding liquidity that Stefan was talking about, and how these things are both connected and they can amplify each other. So, a typical story would be there are some kind of losses in asset values which reduce collateral values, that tightens funding constraints for intermediaries. You end up seeing forced selling, margin calls, leads to kind of asset market liquidity drying up and so on. So I think, at least as a conceptual matter, this is kind of quite well understood, I would argue. And when I think about the kind of different aspects of the post-crisis regulatory reform that were put in place, they're really just trying to target different aspects of that diagram. So, I imagine you're all familiar with these concepts, but I'll just kind of walk through them. So we have things like the liquidity coverage ratio. What is that? That's a requirement for banks to hold sufficient high quality liquid assets. So it's trying to kind of make sure that banks don't need to fire sale if there's a kind of a drying up of liquidity. They can see through a significant liquidity stress episode in markets. Then we have the net stable funding ratio. These are all, it's an acronym soup, isn't it? But this is trying to kind of reduce reliance on short-term wholesale funding, making banks less reliant or less vulnerable to these funding dry ups. The leverage ratio, this speaks very much to what Stefan was talking about in terms of links between capital and liquidity. So you think with less leveraged banks, you're going to get less fire selling under stress. Then you've got things where there's been a general desire and aim to firstly shift lending contracts from unsecured relationships to collateralized lending. So that's been one of the big shifts we've seen over the last 15 years or so. I'll come back to some of the implications of that. But as part of that, regulators have been keen to put in place things like minimum margin requirements, again, to kind of break some of these pro-cyclical loops. And then I'm going to talk a bit about central banks' role in all of this at the end. So you can kind of very much see this is a kind of a connected picture so far. Now, then I guess I would say, despite this, really good conceptual understanding we have and all these policies we've put in place, you'd have to kind of recognize that we haven't been very good at spotting or mitigating problems with market liquidity in real time. And it'd be hard to reject the idea that these episodes are becoming more and more frequent. So these are kind of three, I would say, systemic episodes we've seen, or episodes that have the potential to be systemic crises, I would say. So we had the March 2020 Dash for Cash episode, where even core markets like US Treasuries became illiquid. We had the infamous episode in the UK a couple of years ago, 3 years ago now, when gilt market liquidity basically dried up and the Bank of England had to intervene. That was a pro-cyclical loop. And then we had the SVB case in the United States. So these are, you're then left with a picture of these episodes are becoming more frequent, and we don't seem to be very good at spotting them or dealing with them. So then, some kind of guesses as to kind of why this might be the case. So maybe it's just really hard if you're a regulator to, even though you understand this stuff conceptually, actually kind of piecing together where the real fault lines lie is just really, really difficult. And I think there's undoubtedly some truth to that. I don't think it's the whole picture. So this is a slide from a talk I gave a couple of years ago, which makes the point that if you kind of, so central banks publish these financial stability reports. So at the Bank of England, they've been publishing an FSR for 20 odd years. And you can kind of say, well, those documents are really a description of how the institution sees the risk environments. So this is a simple analysis I did where I said, if you take the terms that appear in this is a financial stability report that was published after the Dash for Cash episode, pick out the things that kind of most frequently occur in that FSB analysis of the Dash for Cash. How often do you see those terms appearing in Bank of England reports? That's the chart on the left. You can basically see the Bank of England was talking about issues relating to liquidity issues in non-banks for a long time, and the kind of focus on that issue was kind of growing and growing up to March 2020. So it wasn't a surprise that happened. Maybe the kind of intricacies of what happened were a surprise, but the knowledge that there was a liquidity problem in markets was well known, I'd say. The one on the right is the LDI crisis in the UK. So again, you could kind of say, well, there was more attention being, there's a bit more of a mixed message there, if I'm being honest. So there was a letter written by John Cunliffe, who was the deputy governor at the time, explaining what happened and what the bank were doing about it. You can see if you do a similar analysis of the text frequency of the terms appearing in that letter, there's more focus appearing, on those issues in the bank's reports. The yellow bars, however, are kind of instances of specific, references to LDI, liability-driven investment, and there you can see there's basically no real understanding that was a real kind of pinch point fault line in the system. So I'm trying to give you a message there that some of these issues are kind of spottable in advance, and regulators did know about them. Not all. All right, so that's explanation one, and the second one is, well, some of these policies we've designed, they're just kind of not working as we'd have hoped or as we'd have intended. And I think the one I'll pick out here, maybe this is a story some of you will know already, but it's the idea that kind of liquidity regulations, when you put them in place, it's not the same thing as like engineering usable liquidity in the system. And there's this kind of very famous Charles Goodhart's parable of like a weary traveler who arrives at a station, kind of sees a last taxi waiting, available with a light on, and the traveler steps into the taxi, and the taxi driver says, "Sorry, I can't take you. There's a bylaw that requires that there's at least one taxi waiting at the taxi rank." And I think it's a really nice metaphor for this idea that just because you've got a liquidity requirement in place, it doesn't mean it's actually a usable buffer that banks can kind of draw on in real time. And I think that's an issue that's plagued these regulations. Third argument is there's a difference between microprudential risk management and macroprudential resilience. So what do I mean by that? Okay, there's one well-trodden example where it's well known now, I think, that the leverage ratio, so that's a tool that's put on banks to kind of prevent them kind of becoming kind of running into solvency issues. There's an interaction there with, at least for dealer banks, their willingness to and ability to intermediate markets. So that's kind of that's one facet of this difference. Another, I think, is an obvious point, which is we basically, by regulating banks very strongly, we've pushed some of these issues into non-banks. That feels like it's been an issue. And the third, I hinted at this earlier, but as we've kind of pushed towards more collateral-based lending, we've made the system more susceptible to procyclicality through swings in collateral values. So we've effectively swapped a counterparty risk problem for a liquidity risk problem. So what's to be done of all this? Where do we go? I think there are kind of two things I'm going to talk about here, really. So the first one is, I think there is more scope for central banks to think more strategically about stress testing liquidity, not just in banks, but I'm thinking much more broadly. I think you can't really think narrowly in terms of the banking system. It needs to be more a system-wide perspective. There was a recent exercise that my kind of ex-colleagues at the BOE conducted that they called a system-wide exploratory scenario. I think that was the language they used. And it was kind of an innovative thing. So they they had like 50 different types of, or 50 different financial institutions. Some of them were insurers, pension funds, hedge funds, asset managers, and central counterparties. So you're trying to kind of picture across the whole financial system. And then these, just like in a normal stress test, these firms were presented with a severe market shock. So this was a 2-week market shock. I think it was designed to look a little bit like a geopolitical risk episode. And then there was a focus on, how things like the gilt markets or corporate bond market in the UK would be affected by this stress. And they kind of found some interesting things from doing this. So they found, firstly, that I would expect you to kind of look at the details on the slide, but the left-hand chart here is basically comparing kind of sales of gilts with purchases of gilts. And it's kind of saying, while there was a big problem that the LDI episode illustrated, it looks like the policies that were put in place after the fact have kind of made the gilt market more resilient to these types of episodes. Banks had enough capacity to buy the gilts that pension funds wanted to sell. That's the kind of intuition. Whereas that wasn't the case for the corporate bond markets. So we can come back to that in the Q&A if you're interested. And I'd just say, like, in terms of like a direction of travel here, I think this is a really useful approach to be taking. What I think the Bank of England will be doing next is basically turning this into a regular survey of how different types of financial institutions, how they react to a set of preset stresses. So not just thinking about one stress scenario, but a whole range of different sizes and types of stresses. That's the sort of panel data set that needs to be kind of built through time. This actually links to an old paper by Brunemeyer, Gorton, and Krishnamurthy that made this suggestion coming out of the financial crisis. All right, my last slide. Sorry, there's a bit of a whirlwind of different topics, but hopefully it's something that we can have a discussion about. I guess for me, like the big thing here is like, what's the role of the central bank in all this? And it kind of links very much with what Stefan was saying about, solvency versus liquidity crises. So some topics that I think are very timely here are, should the central bank be in the business of providing kind of an always open facility where it can lend to both banks and non-banks? That's sometimes called the pawnbroker for all seasons, a Mervyn King, Paul Tucker proposal. There are related questions about, are lending programs superior to actually buying assets? What are the kind of pros and cons of those two approaches when there's a liquidity stress event? I think it also links to questions about how big should the central bank's balance sheet be in steady states? Should we be kind of encouraging banks to kind of rely on their HQLA to deal with liquidity problems, or should they just have reserves at the central bank to deal with these things? And then the kind of big picture question for me is like, what's the right balance in terms of dealing with liquidity issues between self-insurance, asking banks to kind of hold liquidity buffers? That's a costly thing for the economy, I think, versus the central bank stepping in and providing a liquidity backstop. All right, let me stop there. Thank you.
Yeah, thanks so much, David. I really enjoyed your remarks. I am very thankful that you were able to connect sort of the very contemporary issues that you're talking about at the end, sort of to the big picture points that I was trying to make with this talk. I really appreciate that, and I think that's a really good starting point for a discussion. To me, one of the things I've sort of sometimes been puzzled about is sort of what is really, so when we regulate the financials, when we intervene in the financial system, I think as economists we should always ask, what is the friction that the private sector cannot solve that then the government needs to solve? And there are for sure millions of reasons why the government should intervene and by that improve welfare. But I think we always have to sort of start at that observations. And liquidity regulation, I just have not seen. You've raised some of the really sort of simple conceptual issues. You mentioned the Goodhart's taxi. I just haven't really seen very good theoretical argument, and I have not seen any empirical evidence how it sort of really improves welfare. And I just want to, it reminds me always of my PhD advisor, Martin Helvig. And so he may have some extreme views on things, but he always, when I was doing my PhD at University of Bonn, he always had this, he was going around the world and, advocating for stronger capital regulations. And we can agree or disagree with him, but he had this very nice metaphor where he said, financial crisis happens, so here's the regulatory response. So it's like, it's essentially the same as if a big truck loaded with chemicals goes through a tunnel that connects the northern and southern part of Europe. And then that truck has a big accident. The tunnel's closed for multiple months. Trade between the north and south is affected. It's huge, huge externalities. Okay, so what's the policy response? Well, the policy response should be that we reduce the speed limit that was maybe unlimited on these trucks that carry chemicals to a very low number, maybe 50 miles an hour, 40 kilometers an hour, whatever, some number. But the actual policy response that we're getting is something like, oh, the speed limit on those trucks goes from unlimited to 120 kilometers an hour. And by the way, we're also going to have a carbon tax on SUVs because we wanted to do that anyway. So I may be misquoting him, but it was something like that. And so liquidity regulation reminds me a little bit of that. Actually, there's some obvious things we can change in the way we regulate the financial system, but then we throw in some stuff because, even though we don't really have the conceptual foundation for it. So I think I think that's maybe a good starting point to discuss a little bit. What do we think is justifying liquidity regulation?
It's an excellent question. I mean, I should also, begin by saying you and I are going to agree on a whole series of things here. So I'm in the same place broadly as you, but I think for the sake of having a good discussion about this, I guess I'd start by saying there are some kind of clear market failures now related to fire sale externalities or run dynamics and things like that, where it seems likely to me that financial intermediaries left to their own devices will hold insufficient both capital and liquidity. So they'll either rely on the central bank backstop, or they'll just underprice effectively the impact that their deleveraging will have on the real economy. So I think there are things you could point to there. Now, you might have a follow-up question there, which is, are these things really about liquidity or are they about capital? Which I think is a fair point to debate. But I think there are some kind of frictions in principle. What else would I say here? So I think somebody lost my train of thought, which was
maybe if I can, while you get it back, I could sort of say what I think is also what came through really nice in your presentation is there are markets in which liquidity really is an issue. Just think of the U.S. Treasury market. In the U.S. Treasury market, so none of the things that I talked in my remarks about has anything to say about that. And there's ample evidence that market liquidity in that market is not sufficient, and it's potentially hugely impactful because we price off every asset in the world more or less with U.S. Treasury. So that is a big problem. So that's a sort of very different type of liquidity. I think, again, we need to really sort of always think about what market are we talking about when we talk about liquidity. My everything I've said so far is really about banks in the banking sector. Your presentation, which was much broader, and sort of we can think of other markets where there's very different issues.
I totally accept that. I guess the arguments I've heard and that I put some weight on are, even if your diagnosis is kind of completely correct, that these are kind of always solvency issues primarily, there are still kind of two reasons why you might want to require some sort of liquidity requirement or even provide liquidity ex post. And they're kind of to do with either kind of they're mainly about giving you time as a regulator to assess the problem, because you don't know, right? So if it's the case that this is kind of what happened to many regulators in 2007, because banks weren't holding any liquid assets at all, you were suddenly, without really any understanding of the kind of detailed understanding of the position of different banks, you're having to make an overnight decision on whether to close these banks or provide emergency liquidity assistance to them. So I do put some weight on this argument that if you can kind of buy yourself time, that's like an extremely valuable asset in a situation of extreme market stress. I guess the related one is it's about preventing contagion. to a degree. And this is maybe more about why the central bank itself should consider providing liquidity, even if it's ultimately there's a big solvency component to this, which is it may be a solvency component for some banks, but it may be more of a liquidity issue for others. And I think this kind of preventing contagion, I got, at least as an external observer of what happened after the SVB crisis, it seemed like that was part of the rationale for the Fed's decision to intervene, which very effectively isolated the problem. There's a couple of reactions, I suppose.
I think it's actually an excellent point. So at a conceptual level, this buying time argument is for sure correct. I would remark that again, it really depends on which specific market you're looking at. If you're looking at the banking sector, sort of my conviction at this point, given the data that I've seen, is that depositors are just extremely sleepy and slow to react. So there isn't that much. And this is specifically not SVB being an aberration with a lot of uninsured and informed and large depositors. But most banks are financed not by that type of deposits, but by sleepy retail deposits. So as I was showing in some of the graphs, it's so slow moving before you go out of business, and you have this high predictability long before. In fact, supervisors typically are very well informed. So there, I think the reason it doesn't really apply, but it certainly applies in much more sophisticated financial environments. Let's say you have sort of a small broker dealer that is financed purely by informed wholesale funding, and when risk premiums shoot up, then there isn't. Yeah, so in that kind of. But again, this brings me always back to it's really important to think about which part of the financial system are we. And it gets very complicated once you have these large financial conglomerates that are not just commercial banks, but are combining all kinds of business services.
Yeah, very much so. And your point on this, I was trying to think of what are the good cases of pure liquidity events that I could think about, and they would be more market-based things. So I think the LDI crisis in the UK really was a pure liquidity event. Sure, the trigger was unsustainable fiscal policy, but in terms of the impact on markets, the shock itself was actually improving the solvency position of pension funds because interest rates were going up. It's just that they faced massive margin calls because they tried to hedge that risk. So that would be one. I think the other one would be the kind of the dash for cash episode, which was again a very specific markets focused event. Is it
okay?
We've got some hands. Should we take some questions?
Yeah, we have already a few questions. Maybe Katarina, do you want to go first since you have to leave us in a few minutes?
Matthias is okay, because Matthias had first the question in the chat, but if you're okay with that, I'll go first. So first of all, thank you so much. These were two really interesting interventions. One point I just want to clarify, and I think you both recognized it already, it's a different thing whether we talk about a bank-centered system and talking about banks, or whether we're talking about the new shadow banking system where liquidity issues are just of a different dimension. So I think that must be clear. So if we go back to historical data, this might not tell us how we shall manage liquidity today, because our system is much more based on liquidity streams along a long chain of intermediaries, very opaque. We don't know where it is. We don't know who's going to be most vulnerable to liquidity stress, and so it becomes more complicated. We also know, however, that the banks are always involved in that because they provide credit lines, and because they have access to the central bank, are basically the last stopgap measure before the system crashes. But they also have a limited limited availability to provide all the liquidity that might be needed. So that's just, I think it's important to, and I think, Stefan, you said this yourself, it depends on the kind of market that we're talking about. But I also want to emphasize that most of these markets are all joined at the hip, right? I was just thinking about long-term capital management in 1998, a long time ago. But that's also a wonderful example to see how actually using treasury bonds as one of the investment assets for them, and then trying to speculate about the alignment of emerging market debt to US or other major currency debt. That is part of a speculative financial strategy where basically all sitting in the same boat and just saying that is the market, and then the state might intervene and distort anything is kind of difficult because I think it's very much interdependent. And the last, maybe most fundamental comment I would like to make, and that's basically, what is our benchmark? So if we say we take away limited liability for investors and we allow them to self-manage, I'm all with you, right? So, but then let's just take all the legal subsidies that we have built for the financial sector away, and put the risk of engaging in different financial strategies squarely on those people who are involved in the banking sector. Once we have a system where we have basically limited liability, we're basically giving them a lot of abilities to use the legal system to strategize the investment and to take advantage of both our legal system and our money system. All the assets they issue are denominated in official currencies. Everything is piggybacking and free riding on a system that is not private. Then assuming that there is a private sector that could do it on its own, and there's a public sector that might only intervene, I just find this wrong. Just a really misguided benchmark. I know it's very common in economics, but I just want to push back against that. And I think sort of, I'm a lawyer, of course, I'm sort of more into also the charterless money theories, but I think, the systems are so deeply intertwined. And so we have to think about the systemic effects of both their strategies in building out their financial systems, and therefore also have an obligation to think very seriously about the repercussions. And then just the last little point in terms of, they can solve their problems themselves. If I read the crisis of 1907 correctly, yes, some of the banks got together and helped each other, but they also made sure that some people were not part of the rescue package. Right? So the big New York Trust was just not part of the rescue package because this was a potential competitor. So it's not clear that they actually will rescue the market. They will certainly make sure that some banks will, protect one another, but whether this is necessarily benefit for social welfare, I'm less sure about. Thanks.
Can I respond to some of the? There's a lot of really interesting and important things you said. Two things I want to emphasize is let's go to the last one, the 1907 crisis. I think I'm really glad you bring it up. So we're working on a project right now where we basically create a census of bank runs in the United States. We'll read every newspaper that's digitally available, and we kind of identify whenever there's a bank run that's big enough it's in the newspaper. Turns out bank runs in the US happen all the time, but in most cases, the consequences were literally none. The bank didn't even close, or if it closed for a day or two, shareholder just brought in some outside equity. And if they didn't have outside equity, maybe they drew a credit line with another bank. So idiosyncratic liquidity risk, banks can really well deal with. Now, 1907 is then the interesting case. What if the entire financial system has a liquidity issue and everyone understands it's a liquidity issue, but it's still an aggregate liquidity shortage? Well, I think in 1907, you do see the point that there is enough equity outside of the banking system, even if maybe the sort of financial system, that was able to be brought in to kind of contain the crisis. I totally understand that and see your point that there may be sort of strategic issues that one then needs to think through. But I think maybe we've swung a little bit too much in the wrong direction, where we looked at something like 1907 and said, oh, we cannot have the private sector deal with this. And as a consequence of that, every time there's a liquidity issue, including those idiosyncratic issues that the financial sector worked out on its own all the time, we now try to solve them all with liquidity intervention. So that's, I think, where I'm coming in. By the way, also, none of what I'm trying to say is to say we shouldn't be, for instance, insuring deposits. I think it's the right thing to do to insure deposits. But the logic underlying it is the same as the way we have car insurance or health insurance. It's not to eliminate some adverse equilibrium. So I'm not at all trying to push a totally libertarian view on how to design a financial system. I think we just need to sort of sometimes reread the evidence that we have historically that we then have used, maybe sometimes misguided, because we didn't have all the data to justify specific regulations.
Let me just, sorry, go ahead.
No, you go ahead, please.
No, I just was going to say I agree with you, and I don't want to push back too much. But I think sort of going down that line that you just argued, one could also say that the liquidity support, of course, has created the kind of moral hazard that brought us to where we are right now, because we're basically supporting every little glitch in the financial market. And of course, they're exploiting this, and it's the mother of all moral hazards that we have created. So that there, I'm with you.
Yeah. And it is, by the way, I want to make one sort of high-level point on how academia actually works in this respect. Is when we used to write banking theories, we just sort of face the publication process in academia as we can't just write a theory where we have an assumption and then a result. So any theory needs to have some kind of sophistication in it. So the amount of theories we have written that think of these complicated strategic issues and sort of common knowledge breaking down and multiple equilibria, those have been published very well. Whereas the most simple explanations that, you know, not always are the right ones, but sometimes are the right ones, we haven't really put in the theory. So the ratio of the theories that think about liquidity interventions compared to their empirical relevance is out of whack. And that has kind of also led to some of the issues that then, exactly as you're saying, this moral hazard issue may be sort of academically justified through that.
But just one question, sorry, but this is since 2008, because at the 2008 crisis, nobody even had bothered to think about liquidity, no? I think volumes were written and edited where we were trying to figure out what liquidity really means.
Well, if you, within the banking literature, the banking theory literature has, you know, a long tradition, even before the Diamond-Dybvig framework, to essentially think about bank runs and sort of the coordination issues among depositors. It wasn't that was sort of a less that part of the literature was just not as well cited because it didn't really have, no one really cared about financial crises before the GFC. But yeah, no, I think the literature was already going in that direction. But then the historical legacy of the literature in some part maybe have governed some of the policy responses. I think we just always need to review things, why we are doing them. And
maybe I read Matthias' questions again first, and then we'll go with William. So Matthias was asking, could we say the dash for cash in 2020 was a liquidity event, or was it a solvency event in the non-bank financial sector? Too much risky credit being rolled over with a sudden realization that there is a problem during the dash for cash?
No, I think that was primarily a liquidity event in my sense. So, you know, there weren't financial institutions that took, you know, after receiving that liquidity, they weren't in solvency trouble afterwards. Now, you know, it is also true that governments insured pretty much all the credit risk on banks' loan portfolios for a substantial amount of time, you know, in many countries. So it did allow banks to play a particular role in kind of supporting the economy, which may not be general. But I would still say that, you know, the dash for cash episode specifically, you know, we're talking about the events that happened in March 2020. You know, that was about certain hedge fund strategies being unwound and, you know, ceasing to be in the money as treasury prices moved against them. So I think that, you know, it's a problem, a very good example of something the central bank could fix directly. Now, if you look at what happened to central bank balance sheets after that episode, they expanded absolutely enormously. So I think even though it was a liquidity problem, the scale of quantitative easing and asset purchases we saw was kind of out of kilter with the you know, what was needed to deal with that liquidity event. And I think that's a lesson that central banks have, I tentatively want to say this, that I've learned since then, where you don't need to kind of buy and hold assets for such a prolonged period of time. And it's more about acting as a market maker of last resort and kind of unwinding those purchases when needed. But that's, yeah, sorry, it's a long-winded answer to the question.
Yeah, I can just sort of adding one sort of observation to it, which is it's very US specific, but I think when we talk about the dash for cash, there's a part of the treasury market where I think there was issues of liquidity and how treasuries were intermediated. There was no question about the solvency of the US Treasury or anything. It's just the pricing wasn't working well because the dealers that are intermediating in that very specific market were constrained. There's also the credit line drawdowns of non-financial firms at the bank holding organizations, and that is essentially there wasn't really anything other than just non-financial corporations drawing down credit lines and just redepositing them, oftentimes with the exact same bank. In some sense, that's sort of the banking system was kind of working as you'd like it to be. Someone has a big shock; they are not sure how much revenue they're going to make over the next 2 or 3 months, but they're kind of sure they're still going to be in business in 4 months. So they're just going to bridge this by drawing down their credit line. So I think they're the market, and there was a liquidity demand shock, I would say, of non-financial firms, but there weren't any sort of per se liquidity issues in the banking sector.
Yeah.
Yeah, great. So I have sort of two related questions that came out of Stefan's presentation, but I think they speak to David's as well. And they're about the extent to which we can kind of apply these insights from the 1930s to the modern context. We talked about this, I think, a little bit with Katarina's question, but if I'm thinking about banking in the 1930s, this was much more localized, much more relational. Balance sheets were smaller, both kind of in the aggregate and kind of as a, proportion of the economy, right? And when we're thinking about that in the modern context, I mean, balance sheets are just way larger. They're way more complicated, even if we're just limiting it to the banking sector, are much more complex, much wider range of assets that are held across countries, across localities. And it seems to me like this would make it more difficult to assess the solvency, to draw a distinction between a solvency problem and a liquidity problem in the private sector of your counterparties. This might be a little bit easier on a regulatory side if you have kind of a larger system-wide data. Maybe the banks are more efficient at this, but it seems to me like it probably would be more difficult, particularly during a crisis experience. And especially when you have kind of a liquidity crisis that's making it difficult to determine the long run value of assets. And so I'm wondering maybe the extent to which that insight that the private sector can draw this distinction can still be applied in the modern context. And related to that, you talked about some of the difficulty in sort of conceptualizing insolvency interventions versus liquidity interventions. But something I would add to that, I think, is the difficulty of doing that when you're talking about banks that operate across borders. Because on a national level, I mean, I can think of a very easy way to solve a solvency crisis. It's just nationalizing the bank, right? And in some cases, this doesn't work, right? If you're Ireland, but in some cases it does, right? It's possible. And there are other kind of ways that you can intervene to inject solvency on a national level. But once you're doing this across borders, this becomes a question of fiscal burden sharing. And that's where any international agreement, whether it has to do with financial, or otherwise, like that's when things break down. And so it seems to me like part of the driver for that kind of liquidity is that it allows countries to engage in some sort of implicit form of burden sharing without having to actually justify it to the public that that's what they're doing, because it's much less visible if you're doing this through liquidity injections than if you're doing it through direct kind of balance sheet injections. So I'm wondering if kind of the research that you're doing has anything to say about that distinction and kind of the cross-border aspects there.
I think in some ways, both of your questions are about external validity. And so there's always the issue when you any data you study, and it's of course more salient the further back you go, you always have external validity issues. So let's sort of think through what are really the differences. Before I do that, actually, let me say everything I say is really about commercial banking. So commercial banking sort of being standard retail deposit, maybe a little bit of wholesale funding, finance, lending sort of into some kind of illiquid securities. Okay, so it's not about market making. It's not about investment banking. It's not about insurance companies. And, of course, a lot of U.S. financial institutions, large BHCs, are actually more conglomerates of that type. They have some commercial banking, all this other stuff. So I'm really always talking about the commercial banking function. Now, the historical U.S. banking system is very different from any banking system in the world in some sense, because historically banks were unit branch banks. In the 19th century, bankers had lobbied successfully that they get local market power, so no one could enter. So every bank was one branch. And we're still living sort of part of that experiment today, because we still have 4,500-ish community banks as a consequence of sort of this path dependency. So it's structurally a sort of very different banking system. If you think of Germany in 1931, it's actually not that different. It very much looks like, the US banking system now. You have some very large banks that are operating branches all throughout the country, and then you have some sort of more regional specialized lenders. But I think again, it all to me comes back as sort of what are these institutions fundamentally doing, right? So if you're relying on deposit financing from retail depositors, and then you're going to make some kind of loan, there's going to be some changes across time, how illiquid and how long dated those securities are. But really, what is it that I'm missing? If I look at the historical data and I look at a bank right now, it's fundamentally, it's really just sort of getting you the data point that you otherwise cannot construct in the modern setting, where you would have to have a model. You have to make some assumptions, right? So to me, it gets as close. It's the empirical factual, it's sort of the counterfactual that you'd like. It sort of gets very close to it. It would certainly be a bit crazy to just go out and make policy based on that. But I think it's enough evidence in the historical data that allows us to rephrase some of the questions or it sort of gives us a hint of what kind of questions we should be asking when we design financial regulation. So putting it this way, I think there is a lot to learn from the historical evidence, much more than most people think. Of course, it's not perfectly informative, but nothing is. Even if anything you do, if you don't have the data, you're going to have some model. You're going to have to make some assumptions. And I'm actually more comfortable with looking at than some actual historical data.
Yeah.
And I think your second part on the cross-border part, it's just sort of part of the same question. It's just those kind of institutions did not historically exist, or they existed sort of in other forms outside of the commercial banking sector. So yeah, one has to think through, make some assumptions on how that actually affects the design of optimal policies.
Mm-hmm.
Perhaps I could just add one point on the cross-border thing, which is to point out that these are that's the key issue in my mind with why resolution regimes are kind of they work for kind of smaller domestically focused banks, but they kind of run into trouble when you're talking about large cross-border institutions. Aside from their complexity, it's the kind of political aspect of who calls the shots if it's a bank that's operating across jurisdictions, and the related incentives to ring fence capital and liquidity at the kind of local level. So just to reinforce your point, or both of your points.
Can I make another point, which I tried to make with Ellen Ray last month? It didn't land well, but since we're talking about this, maybe I will chime in. I mean, the problem to me, besides the political part, is also about like who oversees these international parts and how do you measure it? Now, let's say that you have a completely interconnected system. Like if there is no perfect information sharing across regulators, across the board, isn't it like a major problem in the whole monitoring? This is something that came to my mind also when I saw the graph of the Bank of England. That's a beautiful graph. But to what extent that has to be integrated with the same graph from Bank of Canada, Federal Reserve, ECB, and so on? Because at some point, like really, like long-term capital management, that originates from a crisis in the Asian financial crisis, which spilled to Russia, which spilled to long-term capital management. So like it seems to me that when we talk across the border for policymakers, it's really about a huge coordination effort that should happen. Now, it didn't land very well with Ellen Ray last month, so maybe you don't want to to include it in your comments as well in a positive way. But to me, that's pretty major.
Yeah, I think it's one of these things in theory. There's an idea of home host supervision that's kind of we know how that's supposed to work, and in terms of information sharing. But I think I agree with you. There are huge issues in practice. I mean, to take a specific example, I think some of the most interesting research that's happening in terms of kind of current liquidity in the non-bank financial system uses trade repository information. So it's kind of very high frequency. You could basically see institutions' position yesterday. So it should be incredibly valuable, but every jurisdiction only sees the transactions that involve institutions that are domestically domiciled. So the Bank of England, for instance, will see UK banks, UK hedge funds, exposures in derivatives markets globally, but they won't see transactions that don't involve a UK counterparty. So the whole picture is there of everybody kind of pulls this information, but they don't in practice. It's kind of viewed as sensitive information that's kind of not shared. So I think that's illustrating your point, Dario.
I mean, my initial reaction would just be that this is actually not specific to liquidity issues. This is sort of to many industries. It applies that sort of there may be good reasons that we have institutions, corporations that operate across national borders and across different jurisdictions. But that generates also all kinds of problems that maybe require a global response. And that's just, you're getting into a discussion about political economy. That's just a ton of frictions that make it difficult, I think, to do optimal policy. This doesn't need to be about liquidity. This can be about other more global issues such as climate or whatnot, where there is some kind of externality, and it needs a global response. And it's very hard to get across jurisdictions, and there are free rider incentives. And maybe one can construct an argument where very specific regulations that look kind of in of itself strange make sense once you take into account those more global factors. But then my sense would always be that these are politically economy driven things, and they're not really optimal policy.
I agree. If there are more questions from the audience, I will let them. I also have other questions, but I will first let people from the audience speak.
David, you mentioned, and this for both of you, a question. Like, it seems today we're living in a world that all the savvy financial market actors do assume liquidity bailouts, and they base their strategies on it. And it's not the first time that I hear it. I hear it from you, but I also hear it in other interviews that the market players become even more aggressive in their risk taking because they are fully pricing in liquidity bailouts. Is there any way to get these guys out of these assumptions without having to provoke a Lehman moment, right? I mean, in the end, basically, I think historically speaking, with the Lehman moment, the equilibrium completely shifted, and everybody is assuming there will be a bailout. And I don't see how we get out of it, on the one hand, because nobody wants a Lehman moment, on the one hand, and on the other hand, that just means more and more risk-taking, and I would even claim an overproduction of credit. Logically speaking, I think I can build for myself a logical chain there. So is there any way to get out of it, or we just say that's it and we just live with it?
Everything you said intuitively it resonates with me, but there's sort of, I think, still some uncertainty to which extent, which parts of the private sector are expecting interventions, and whether you call them a bailout or not. I think there's sort of some subtleties around what we really mean, because making a loan to someone is not necessarily a bailout if you get paid back. So I think that in some sense is at the heart of often the problem of making solvency interventions, because they often can look like a bailout, even they may not even be. But anyway, so I think so I just want to put a little bit of break on that. I'm not sure that, it's very hard to measure the kind of moral hazard issue and quantify the moral hazard issue you're alluding to. But I think if one were to if we were to agree more collectively that there's, maybe too much focus on liquidity and not enough focus on solvency, I think, again, then you have to tailor it around each specific market. But I think there are very obvious ways of reducing, for instance, regulatory requirements with respect to liquidity, which may be in part increasing the reliance of the economy on the shadow banking sector, because it just makes the banking sector less productive, and just sort of going with the regulations that are more effective, right? So whenever you do a regulatory intervention, there's going to be someone who doesn't like it. So I think the best way to regulate the financial sector is just to focus on the most efficient regulations first and put all your eggs in that basket. I think there would be again, this is not an official policy position that I have from the Federal Reserve, but I would think that there's some scope to just shift the emphasis to solvency in the regulatory frameworks.
I do think there's a kind of a widespread expectation in markets that it's specifically around asset purchase interventions, I think, and that's the nature of the kind of bailout problem for me, which is that the Fed specifically is viewed as having a reaction function where it will buy private sector assets in the event of a stress, and that's kind of the thing that's kind of priced in. And I think there's an interesting distinction there between kind of lending programs of the sort, Stefan, you were mentioning, versus these outright purchases. Whereas if it's a kind of a loan and you're taking good collateral and the loan is kind of priced according, this is Bagehot's principle, that should be kind of less prone to some of these issues. So kind of moving in that direction is one approach. There's also a question about what are the limits to what the central bank can achieve through this reaction function. Are there some shocks out there, which I guess are more solvency type shocks, that the market's expectations won't be fulfilled because it won't be a problem that can be solved through outright purchases? So that's another, communicating what the shocks are would be another approach to trying to kind of dial down this built-in moral hazard.
Matthias, you have one more question?
Thank you. I don't mean to monopolize. I'll just ask quickly, and then one is just a reaction, one is a question. The reaction is I'm not I am a German, but I'm not a German disciplinarian, neoliberal market discipline guy. But I find it funny how the economic profession has moved from moral hazard is a huge problem to moral hazard is hard to measure. And that's not anything against you, Stefan. It's just I observed this in several conferences where this was an argument. I'm like, okay. But then more maybe to the point, I wanted to ask both of you, these liquidity interventions, and you've raised it, I think both, they really create right now big problems for all the central banks. So all the central banks are losing money. I mean, okay, you can say that's not a problem, and that's an interesting point when you say central banks losing money is not a problem. So, but the limits of this situation, of this intervention technique are coming now to the fore, because they produce losses for the public. And my question to you is, as a reaction to that experience, do you think that what David, you called the reaction function of the Fed is going to shift dramatically, or is it going to stay the same? Like, are we going to continue with this? Any problem? Let's go into the market and just provide the liquidity kind of equilibrium. And I know that I haven't answered to Stefan's very valid points, which are...
I don't know if Stefan can answer that. So shall I have a go, given his position? I would guess there'll be an element of it that's still there, but I think the key issue that we saw after COVID was just the scale of purchases and how long they stayed on the balance sheet for. And that's why we saw such losses afterwards. So I think if it's more of a market maker of last resort type operation that's kind of very short-lived and targeted and that's unwound, you won't see the kind of scale of losses that happen afterwards, but the intervention will still be there in the first place.
Let me maybe also just say we're starting to sort of like observe at the high level that we're kind of combining now issues of monetary policy implementation and financial stability, right? So Fed purchases of assets are not sort of justified, at least by liquidity interventions, but they're sort of an attempt to influence longer dated interest, at least that would be the argument that's officially made. Just let's observe that. I think that's not meant as a liquidity issue. It just raises maybe a sort of a bigger question of sort of what is our conceptual, how do we conceptualize these different issues of monetary policy and financial stability? I think we're kind of lacking a little bit a clear framework that gives us guidance. And it's just sort of an observation that there's lack of this sort of, framework may be part of the issue that we're sometimes doing some policies in some area and they're influencing things in some others, and we're kind of a little bit lost in understanding what's affecting what.
I agree with that. We're using the same tool, which is ultimately an asset purchase. There could be a whole host of different reasons for why that's happening, and it could be about trying to boost aggregate demand, and increase the money supply, regardless of what you think about the efficacy of that. Or it could be to try and target a financial stability problem, a dysfunction in markets that you're trying to kind of alleviate.
Yeah, I think maybe this is I've sort of a maybe slightly provocative, bigger picture question to ask that I think has born out of this, which is coming back to this point that David made about resolution, which is something very kind of near to my interest. It's the subject of my dissertation, so I'm very, very interested in what you think about this, which is that we've been talking about this moral hazard problem for the last, 15, 20 minutes, and this is the case in a lot of other discussions where a lot of the discussion of, okay, well, how do we deal with this problem comes down to a question of regulation, right? We just need kind of more stringent regulation, and then this will be, how we actually intervene in a banking crisis will be less salient. But this was kind of the general, practice for the 40 years leading up to 2008, right? That we'll just set aside the question of what we do when banks fail, and we'll just try to regulate them enough so that they don't. And they still did. And after 2008, we have made some steps towards having a crisis management system, but still mostly are focused on kind of regulation. And we still, in 2023 saw major bank failures. And so I guess my question then would be that if it is so difficult to conceptualize how we can create interventions that do not exacerbate moral hazard, then what does that tell us about the optimal structure of the financial system, and what are the actual practical policy implications that that has, right? Is this that we need to have a much smaller and more diversified, or more, should we break up the large institutions? Should we think about really seriously, dramatically overhauling our regulatory system? I want to maybe push you on those questions.
I don't think I have any evidence to say something about the latter, whether that's a good idea or a bad idea. I will say that in the United States, when banks fail in the contemporary U.S. banking system, it's usually, I can't really say whether it's efficient how they are reorganized afterwards, and with FDICs, that's hard to assess. But actually, the closure process is very predictable. It's long before a bank fails, supervisors understand that the institution is in trouble. Supervisors will slowly require the bank to actually reflect that financial distress in the financial statements, such that at some point the financial statements warrant some kind of legal action, which then eventually results in the closure of an institution. So again, when it just comes to commercial banks, even before the GFC, the system in some sense is working. It wasn't working super well in the 80s, but there were some reforms in the early 90s that actually make the regulatory supervisory landscape deal really well with most bank failures. What I mean by really well is that the losses on uninsured deposits in the United States tend to be extremely low. They tend to be, since 2008, including the GFC failures, they're 3 cents on the dollar for an uninsured deposit. It's very low because the FDIC closes a bank and sells whatever value is left in that institution to another bank. To me, if one thought just about commercial banking, the system should, in my view, be you have strong capital requirements, but you don't create too many other requirements, and then you have strong auditing and enforcement around those capital requirements. You make sure that the capital is measured correctly, that realized risk, credit risk or interest rate risk or whatever it is that the bank has done on its asset side is actually reflected in its capitalization. And then legal action is taken when a bank is sufficiently undercapitalized. Again, this is a simple thing to say, and I'm not the first one to say it, within commercial banking. It gets much more complex, and I don't really have anything to say that once you have big conglomerates that combine all kinds of activities.
Yeah, I think that's the kind of nature, you've hit on the nature of the problem, really, Stefan. So I'd agree with you. You need to differentiate between institutions that are kind of small enough that you can resolve them and, domestically focused enough that a simple framework of a solvency requirements and resolution basically does the trick for them. And then the big systemically important banks that are the problem, where those just are not viable tools. So for those systemically important banks, we still allow them to be leveraged 25 times, a number like that, 30 times. If you think about the Basel III leverage ratio of 3% or a figure like that, that's an awful lot of risk that's being taken. these institutions have balance sheets roughly the size of a medium country's GDP, and it just seems kind of implausible to me that you're going to, through supervision, you're going to be able to kind of guide these institutions and spot risk and spot bad practices in such a way that's going to make that system foolproof. And you can't resolve those institutions ex post, regardless of the setup we put in place. So it does seem like an unfortunate equilibrium that we're in right now. I guess it puts a lot of spotlight on like what are the benefits of these very large conglomerates, systemically important banks. Is it kind of worth the risk, having institutions of that magnitude? I think that's a really important public policy question.
Great.
Okay. Maybe in the last 5 minutes, I will shift gears a little bit. I will ask a few questions myself. So one is, I have in mind two different Stanford positions. One is the one of Amit Seru, that seems to be the same position of Stefan, that it's the same, it's a problem of stability, right? Or of capital. Like capital is very important, and we should increase the capital ratio. And then I have another Stanford idea in mind, which is one of Daryl Duffy, saying, look, when these capital requirements increase, at some point these intermediaries get worse and worse at providing liquidity to the market. So potentially there is this higher capital requirements that end up deteriorating the liquidity in the market. So I was wondering whether you think of them also with some complementarity versus substitutability vis-a-vis complementarity, whether you have also more sophisticated opinions on how, according to the markets, maybe they interact or they don't interact. And then I have an even more basic question than that. I agree with the idea that it would be ideal to increase these capital requirements, but do you have a sense up to what level? Like, is narrow banking something we should consider? Is it like 30% capital requirements? Where is it? And then I also have another provocative question. Stefan, you mentioned the friction, right? Like, what is the friction? Now, and you were saying like depositors are very slow moving. So of course that could be an informational friction. I am a depositor, I'm not going to check the balance sheet of my bank every day. Potentially this bank is increasing the non-performing loans. And so there was, after the crisis, this idea that there's optimal opacity. Like, do you have a sense about whether we should actually get rid of the frictions, like informational frictions, or if there is something like optimal opacity, both in over-the-counter markets and not, that we should entertain? These are sophisticated, that is probably a difficult question, but if you can try and get a shot.
I'm happy to say a few things. So first, I think on your juxtaposition of Amit and Daryl, they're probably both right, I wouldn't contradict either of them, but I will say that it kind of is actually a nice connection to something we've touched upon again in this discussion, which is in the treasury market, for instance, maybe intermediation is done by broker dealers that are associated with large bank holding companies that are subject to the current regulatory framework in the United States. And maybe there are side effects where, for instance, the supplementary leverage ratio is constraining the balance sheet size of the entire organization, and that has adverse effects in that specific market. And then there's obviously something that, the regulation is just not tailored enough around the specific needs, taking into account the different lines of business of those large companies. So it brings us back to the discussion, okay, when we talk about these large financial organizations, maybe we need to think very clearly about which specific lines of business they do and what kind of regulation those are subject to. So Daryl's point would be probably the treasury market is illiquid because of some constraints on those dealers. And I would agree with him. And then Amit's point would be, well, a bank, is going to fail if it's insolvent. So we need to make sure banks are well capitalized. That's equally true at the same. So both can be true at the same point at the same time. So sorry, remind me. Your second point was your second question was.
I think it was on the informational friction and optimal opacity.
Yeah, so I think the optimal opacity, to me, what my research has shown, let me just talk about that, is that even before deposit insurance, in the world in which depositors are going to realize massive losses on their investments, depositors don't seem to react very much to information that's sort of available to them. Sort of like what I literally mean by that is I can have a predictive regression where I use information that's in principle available to the depositors at that point in time, publicly available information that's going to predict in a sort of simple conditional probability sense that a certain bank is going to fail with a probability of, say, 10, 20, 30% over the next 3 years. Okay. And still, depositors have not withdrawn their funds because me as an econometrician, I am able to observe those banks that are going to fail with this 30% chance. Okay. That tells me, well, those depositors are either having super high transaction costs or just not paying attention. And it's even in a world without deposit insurance. So there seems to be something that depositors just don't seem to look at deposits as financial investments the way they look at maybe at their investment in the stock markets or other kind of securities or their house, whatnot. I think that's sort of, I think, a fundamental truth. In some sense, that's how banking is working in some sense, right? So I think anything you want to think about in banking is the starting point is that the depositors are just not going to pay a ton of attention. The retail depositors, not the wholesale part of it. So I think that should govern anything you think about in banking. Let me just maybe leave it there. I don't think you need, design opaque assets because of that, but that's sort of a broader discussion to have. Maybe we don't have enough time to.
Because there is also a point by Gorton that a safe asset is safe only to the extent that no questions are asked.
Well, put it this way. It is true that a bank that is insolvent can exist forever almost, close to forever, approximately, if no one requires any interest rate and no one ever withdraws their funds. That is true, but the empirical evidence historically shows that once things get sufficiently bad enough, depositors do react to the information and then determine the timing. But that's sort of, again, this is my point I made earlier. It's the depositors are not causing the failure, but what does sort of not work with the Gorton view of the world, where is that it's so easy to predict which banks are in trouble or not. So it doesn't seem like the system as a whole has made itself opaque and is pooling the good and the bad stuff because it's obvious to see. It just seems like people are just not paying attention.
And it probably goes back to the point you made on Germany, the fact that the bankers could actually provide liquidity to the right ones rather than the wrong ones. David, do you have any other point you want to add?
Maybe I'll have a go at you asked the difficult question of where should capital requirements go to?
Oh, right. That
was words to that effect, didn't you? So, I agree with like the excellent point Stefan made about the supplementary leverage ratio. Maybe we need to look again at the design of that. And it may be kind of impairing liquidity provision in a particular market. There may be kind of longer run solutions to that problem, basically just not requiring everything to go through dealer banks and having this idea of all-to-all trading where, buyers and sellers can just interact rather than having to go through dealers. But that'll take a bit of time. So subject to that little wrinkle, I think there is a case for kind of going further than where we are in terms of Basel III and all this stuff. It's really hard to know where the kind of optimal capital point should actually be. But it certainly doesn't seem to me that we've raised capital requirements to such a level where solvency risk in the banking system is like off the table, or where banks are unable to provide credit to the real economy. I mean, that would be I think that's just blatantly false. So that I always like the idea of like go a little bit. Let's see what impacts we're having with these regulations, and then go a little bit further. I'm not sure if it might even be a Martin Helvig idea, that one. I'm sure I've heard him say something similar to that, Stefan, in the past. So I'd say, it would be a good time for us to kind of have a further increase in capital requirements. I'd like to see ratios kind of north of 20% rather than where we are. And I doubt the real economy consequences of that would be things that anybody would actually notice. It would reduce bankers' bonuses, of course.
Right.
Actually, I did have something to say on this issue too, which is, if I have 1 minute, which
is
forgetting about for 1 second about the optimal level of what we think, whether it's 30, 20, 15, 10%. It's actually kind of interesting the way we think about regulatory capital is really thinking about book equity. And I would rather push two things, which is one should take into account the value of a bank's liabilities too. That's why SVB looked great in the regulatory capital ratio, because it was just about the assets and not about the liabilities. So I think that's one thing one should sort of think a little bit about. Banking theory tells us a lot about liabilities being important in banking, but then we go to the regulatory capital framework. We kind of just don't take that into account. That seems an issue to me. And then another one is just, even if the level of required capital is relatively low, it really is a question of how quick can supervisors be in spotting and enforcing banks to recognize realized losses and then requiring them to recapitalize. So you can, in principle, have a bank operate with not that much capital if that bank understands very well that, well, if it falls short of some threshold very close to its current capital, it's just going to get close and the consequences are going to be severe for the existing shareholders. That can work if the owners of that bank believe they can raise capital in instances it's needed, but will live with the adverse consequences otherwise. So I think there's a little bit more of a broader discussion to be had, thinking about the dynamics as you have adverse shocks. How do you react to them? What do supervisors do? What can they do legally? What do they know? So I think I would like to see more discussion in that direction rather than just throwing out, okay, let's 50% equity. I think there's more we can use. There's a lot of knowledge that we have that I feel like we're not using right now.
Thank you very much. We went a bit over time, but we also started a bit late, and it was an interesting conversation. Thank you so much, Stefan. Thank you so much, David, for your presentations and for your interventions. I think it was very, very interesting. And we are done for the semester in terms of the lineup. We are going to meet next academic year, probably. So thank you for the ones that stayed until late, and thank you for your kind acceptance of our invitation. Bye, guys.